I wanted to stick with the affordable California housing theme again in this video, and today I'm over here in Rohnert Park, and this house right behind me that you guys are looking at is right now for sale for $699,000, which probably sounds crazy if you live in the Midwest, but this is pretty cheap for California, and this seems to be a very nice neighborhood. It's right across the street from the school. And here's the thing, guys, this house, whoever bought this house in 2012 got it for an absolute steal. They bought it for $180,000 back then, and then turned around and sold it back in 2015 for I think around $450 or $480. So they made a massive killing on this house. That person made even more than this person's gonna make with this last bubble. And anybody who saw my previous video about this whole bubble economy, this house is a perfect example of that right now. When somebody could buy this place back in 2012 when things were still very affordable, probably the best time to buy in the past 20 years essentially, and they bought it for $180K, turned around and sold it for $450 back in 2015. That is an absolute massive deal for that person, guys. Just turning that property around in 3 years is amazing for that price. And even today, they can't turn it around for the same level of profit and over a much longer time period on top of that. But all this bubble stuff is going to be coming to an end. And I'm not the only one that thinks that. In fact, the economist Gary Shilling, he says the US economy is headed towards a recession, but we're probably already in one. So sounds a lot like me. And so right now, the Fed's goal is to kill inflation. And we're seeing inflation tick back up in the wrong direction again, with 2 months in a row of the CPI starting to go back up. And I'm sure this is freaking the Fed out right now, and they probably don't know what to do. And that's why a lot of people think that at the meeting this week, they're gonna just keep interest rates where they're at. They're not gonna raise them. They're definitely not gonna be lowering them. So they're just gonna keep them where they're at for another meeting and see how things go and see if this inflation problem continues to get worse or not. But this guy, Gary Shilling, he called the 2008 recession, and he pointed out that recessions usually don't start until the Fed begins to cut rates. What have we been talking about here on the channel? Exactly that. If we look in history, in the past, 80% of the time when the Fed raised rates and starts lowering them, that puts us into a recession, guys. 80% of the time. So I guess you could say, well, then there's a 20% chance that it's not gonna happen this time, Michael, right? Well, maybe, guys. But the thing is, everything has gotten so far into this bubble, and it's pretty much impossible for it to sustain. At least that's my personal opinion. And I am not a wizard. I don't have a crystal ball. I don't know exactly where things are gonna go. But if I had to make a call on it right now, like I've been doing, it's not gonna last. That's what I think. This is something you gotta contend with. You have the train going right behind your house over here. Although I have to say it's not that loud, but it is kind of annoying because you're hearing the bells ringing and the train going by who knows how often. So I'm sure these houses over here are probably cheaper. Now we also know that another telltale sign that the recession is going to be coming is the Treasury yield inversion. And the recession doesn't typically come until the yield curve actually uninverts. And literally every single time, with no exception, since the 1960s, when the yield curve gets inverted, it's followed by a recession. So to think that it would be different this time is kind of a fool's errand. And basically, in case you don't know what that is, a yield curve inversion is when short-term duration yields rise above longer duration yields as a result of a rising Fed's funds rate and investors piling into safe haven assets like the 10-year Treasury. Also, you have the Conference Board's leading economic index. That's been pointing to a recession since last year. Now, because we're heading into this recession, if we're not already in one, which I believe we have been in one since last year as well. But anyways, when the hammer drops, he thinks that the S&P 500 is gonna fall 40%. And he's talking 40% down from the peak level back in 2022. So he thinks it's gonna go down to about 2850. And right now it's hovering around 4,000, something like that, 4,200, 4,300. And the reason for that is simple. Recessions usually mean a steep sell-off in stocks because people need money. So also you have panic selling, just like real estate. People are afraid to lose even more, right? So when they see things starting to tank, they want to pull out before they lose everything, essentially. And if you think this is unheard of or it can't happen, think again, guys. In 2020, the S&P 500 fell 35%. In 2008, it fell 50%. And in 2000, during the dot-com bubble, it fell 45%. So it is not really that crazy for it to fall 40%. This prediction of the S&P 500 coming down by 40% when the hammer drops is not that crazy. But yet, you're going to have a bunch of people here, even probably in the comments, that say, oh, that'll never happen because the Fed will do this and blah, 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 blah. Well, let's see, right? Because history has shown us that it definitely is possible. I believe it's certainly possible. When you have people like this that are seasoned economists that are looking at all these different indicators that this entire economy is in a bubble right now and it's about to burst, and they think it's likely going to happen again, I listen. Because I'm not an economist. I'm just a guy talking here on YouTube, giving you guys my opinions on what I think is going to happen after I digest all this data and information. The reality is, guys, like, if we're in a bubble, which we are, it needs to be able to have some sort of catalyst to pop it. And traditionally speaking, a recession is a very good needle, if you will, for the bubble to just burst this thing. And I think that's really the last thing that needs to happen before we really start to see the economy do a 180. I know a lot of people think there's going to be no recession, there's going to be this soft landing, because you keep hearing all these different stories and the Fed talking about this and all these different news articles talking about how we've reached the Goldilocks zone. I can't believe it. We're going to have this amazing soft landing and everybody's going to live happily ever after. But that's not the reality. And the other problem with the whole stock market is you have a few top performing companies, especially with the S&P 500, that make it look like the stock market's doing extremely well when they're really pulling the weight of basically everybody else, because all the companies that are not mega caps, okay, they're in big trouble. And that's mainly due to the interest rates and where they're at, and companies having access to capital and loans right now, which is completely drying up due to the banking situation. And then you'll have, of course, people saying, well, none of this is going to happen because unemployment is still low, but it is ticking back up. In case you haven't noticed recently, it's getting close to 4%. Now, that's not danger territory by any means, but the fact of the matter is it's going in the upward direction right now. Consumer spending has been strong for a while until it isn't. So I think that's going to be coming to an end as well. Even the Fed says by October, guys, most people are going to be out of money. And that's right around the holiday spending time when you're supposed to see everybody going out buying Christmas presents and spending all this money, and it might not happen. And the thing is, we need to find out how well this economy is actually going to hold up in a period of sustained high interest rates. And a lot of people will also argue, well, the Fed can't keep interest rates high for very much longer because it's bankrupting our countries and we're paying too much in interest payments, which is true, it is. But like I've said before, the Fed's going to have to make an important decision. Do we sacrifice the economy or do we sacrifice inflation and have inflation run hotter than it's supposed to be? There's really no right answer, guys. They can only do one or the other. They can't do both, unfortunately. And they even say right here in this story, listen to this, spiking unemployment and further signs of weakening consumer demand could suck the air out of these high market valuations. So everything that you're seeing right now with the housing market and the stock market looking like euphoria can easily be turned around as the unemployment rate starts to tick up, and it already is ticking up. So you need to be paying attention to these things. So, you know, we've heard for the longest time how unemployment's at record lows, and it has been for a long time. But the fact of the matter is, it's going up, guys, just like inflation is going back up. And if you think that's a good sign for things, it isn't. Unless you're like me and you are optimistic about this whole coming crash and believe that it's going to be a good thing and healthy for our economy overall. If you're like that and you're like me, then it is a good thing because it means we're headed on the right track and finally we're going to see this thing come crashing down. Now, another thing I want to take a look at is what the mortgage industry is going through right now and what they're saying and doing. Because obviously, without the mortgage industry, there would be hardly any real estate transactions because most people can't afford to buy real estate in cash. So 90% of the time, people need to get a mortgage to buy a house. Well, let's take a look at some of the things that Fairway Mortgage is saying right now. Tip of the week. Second home sales in Florida have plummeted over the past year, and most of the blame can point to Fannie Freddie Mae. There's a new loan pricing adjustments that went into effect in 2022, and it made the cost of a second home the same as if you were purchasing the home as an investment property. But some lenders are getting creative to lessen the cost to borrowers and still want to purchase a second home. By doing a combo loan, such as 60% on the first mortgage and a HELOC second behind it, that reduces the total discount points a borrower would have to pay versus getting one higher loan to value mortgage. So for example, a buyer with a 750 credit score financing 85% on a second home would have to save 3.375 discount points, around $14,000 on a $500,000 purchase, by doing a 60% first and 25% HELOC second versus an 85% first. These are the type of solutions that will get a buyer off the fence and into that home. Now look at that last sentence. These are the type of solutions that will get the buyer off the fence and into that home. This is what they want you to do right now, guys. They want you to buy into this bubble, because if you don't, they're all gonna go out of business. It's really that simple, you know? And sorry if you're in the mortgage business and you're hearing this, and you guys know how tough it is, and not everybody's struggling. There's still people that are writing loans, but it's getting to the point where they have to do these crazy hoops through loops financial situations in lending in order to get people into houses, guys, because nobody is thinking that it's a good time to buy. And then you have these regulations that have second home buyers on the sidelines, and they figure, well, let's target them because they're the ones that have the most money to burn. If you can afford to buy a second home, then chances are you're doing pretty good financially right now, and this is the type of program we have for you. Now let's take a look at what else they're saying, which is important to really keep in mind when it comes to being a home buyer, okay? They say, tip of the week, trim notices are out. This is one of the most important things you will read today. Make sure your loan originator checks the trim notice when you are writing up an offer on a home. Most underwriters are going to use the new proposed taxes if they are higher than the current taxes. Since we all know we qualify borrowers based on a debt-to-income ratio, using current taxes might work for a deal, but when you use proposed taxes, it could kill the deal. Do the homework up front. And this is something I actually agree with Fairway Mortgage on, and it's something I talk to you guys about all the time on the channel. The thing is, there is some truth to this, but also not. And here's what I'm saying. So when you're looking at a property, say we're looking at this house, we're gonna walk right past it again, and you wanna buy this house and you look at what the current property taxes are. I don't know what they are, but if I had to guess right off the top of my head, it's probably like $7,000 a year. I don't know. But next year it's supposed to be $7,500. And the mortgage company qualifies you based on $7,500, except there's a problem. And here is the problem. The problem is that when you buy it for $699 or $650, whatever it's gonna be, your property taxes are gonna shoot up past $10,000 a year, and you're not being qualified based on that. And that's the real problem. So they're qualifying your debt to income ratio based on a $7,000 a year property tax bill, but after your first year of ownership, when the property gets reassessed, your new property tax bill will be $10,000. So that's something that the mortgage lender's not taking into consideration, which is kind of baffling to me. Like, yeah, it's good that they look at the next year, and they're saying to make sure you have a mortgage lender that does that, which is good advice, I guess. But the problem is, it's still not an accurate representation of what your property taxes are going to be after you own the house for a year, guys. And this is something that most people don't know. So I talk about these things here on the channel to help you and make sure you don't get burned, because that's an extra $3,000 a year for anybody who's counting. So what is that, like $250 a month? That's a lot of extra money that you might not have. And so it's not just economists and me saying that the economy might be in trouble right now. In fact, we have the most recent builder confidence survey dropping into negative territory. And that's a big surprise even for me, because I would think home builders right now would be super optimistic about the housing market, because these guys have been selling homes like hotcakes because of all their incentives and price reductions that most sellers aren't willing to do right now. But yet they're not feeling good about the future? Well, why is that? Let's take a look. So builder confidence fell 5 points in September, down to 45. According to the National Association of Home Builders. This is now a 2-month decline in home builder sentiment, which it coincides with mortgage rates going back above 7% again. So now home builders are facing unaffordability, just like regular home sellers are, with people not being able to afford to purchase their homes. And then you have, on top of that, they're dealing with shortages of workers, they're dealing with a lack of buildable lots, and also there's this huge insurance crunch right now throughout the regular housing market that's making it even harder for people to buy homes, because some homes are just uninsurable now, guys. I don't know what insurance costs on houses around here, but there's places where you can't even get insurance anymore. And for the average Joe, insurance is just going up right now. Home builders are getting worried because housing inflation, or shelter inflation you can call it, is up 7.3% year over year right now, when the consumer CPI is at 3.7%. So clearly housing is running at a much higher inflation number than inflation as a bundle, and that's a problem, guys. And when you combine the fact that mortgage rates are above 7% again, and probably will be for the foreseeable future right now, that spells disaster for the construction industry, because even with all of their shenanigans and games and incentives and whatever they do to try to sell you a house, it's not enough anymore. That's the reality. At a 7% rate, at the median home prices, people's incomes just aren't there. That's the reality. Now, right now, the average discount for a home builder is 6% off the sales price. And in September, 32% of builders say that they are cutting prices right now. That's up from the August numbers, where only 25% say they're cutting prices. So just in 1 month, you had the amount of home builders cutting prices go from 25 to 32%. So right now, the average price discount for home builders is about 6%. So they're discounting the rate by 6%, but they're also giving you a mortgage rate buy down. They're also giving you, free upgrades throughout the house. And so that all adds up. And builders are always going to want to rely on incentive programs rather than cutting the price if they can, because the more they cut the price, the more people who are under contract pull out of the deal, which is really bad for home builders, because now they get stuck with all these houses that are unsold, essentially. And if you think the price cuts are high, check this out. 2 out of 3 home builders, which is 59% by the way, say that they offered incentives to buy their homes in September, guys. So if the best deal in town, which is a brand new home right now in most cases, because you're getting the best bang for your buck, is going this far out of their way to discount homes and create incentive programs for you to buy them, what do you think that means for the future of the housing market? To me, I interpret it as things are going to be heading into a downward direction, which they already are in many cases across the country. Not everywhere, of course not everywhere, guys. Never think I'm saying it's going down everywhere, because if you think that, you're not listening. That's not what I'm saying. I'm saying in a lot of places, prices are down, but not everywhere. And literally 42% of home builders' customers right now are first-time home buyers. And that is a lot higher than it was in the past, because back in 2018, only 27% of people that bought a new construction home were first-time home buyers. Fast forward to today, it's 42%, because first-time home buyers are typically the most desperate to get into a home. They just want to get on that property ladder, and they're looking for, where can I get the best value right now? And funny enough, it's actually usually with a brand new home in most cases. But even that's not enough to have builder confidence be going up right now, because they know that the direction things are headed, if it keeps going like this, pretty soon nobody's going to be walking through their sales doors, because nobody's going to be able to afford to. Hey, nice to meet you. I'm filming a YouTube video.
Nice to meet you guys. Yeah, I always see people walking around. I like to see what's going on. And
that's great.
You guys are.
You're a good neighbor.
I've got like 8 cameras running around my house to make sure we watch the neighborhood.
I don't blame you. I would too.
I would do the same.
And honestly, it's a good neighborhood as far as that goes.
Come this way, because this guy won't.
Nice to meet you, Phil.
Nice meeting you too. Take care.
Bye. So quick interjection. I just met one of the neighbors here. His name is Phil. He lives right down the street from here. He said he's been in the neighborhood for 25, 30 years, and he said it's kind of been going downhill ever since, which is really sad, guys. And he said you see people now that can park in unlimited cars here, and they're just making a mess of the neighborhood and dumping things in the drain, which might not sound like big problems to a lot of people, but when you see an area go into decline, I'm sure it's really sad to watch stuff like that happen. So, and it lowers the quality of life for everybody in the neighborhood, unfortunately. But anyhow, getting back to the video, one last point I want to make here is, Target has been in big trouble, okay? They thought it was a good idea earlier in the year to start telling everybody how to dress and what to wear, which I'm sure most of you know about, and I'm not going to get into all the details with that. But they have lost a ton of money by doing that, okay? Their shares fell 3% on Monday, and they're down to $119 a share. That's already down 6% for the month, and Target's already down 20% so far this year. So these guys are not doing well because of their decisions, essentially, to get involved in things that they probably shouldn't be involved in. And now they just announced a campaign that's going to be coming up for the holiday season, because believe it or not, these guys are already gearing up for holiday sales. And here's what they're wanting to do. They're going to hire 100,000 additional employees across all their locations because they're expecting an uptick in foot traffic beginning in October for the holiday shopping season. We'll see, right, if that ends up being the case. And of course, it's not just them. You have Amazon doing this, Walmart does it as well. But the thing is, last year, guys, according to Target's holiday sales, it only went up 1% for the year. So the holiday shopping season from 2022 from 2021 only went up 1%, which is already not a great sign. And they're blaming the fact that they had to do price hikes because of inflation and they had too much inventory for their lackluster sales. But in reality, there's no speak of the economy not doing well. And recent reports are suggesting that retailers could be in for one of the slowest holiday shopping season in the past 5 years, and could even be back to pre-pandemic levels now that all the excess savings are dried up and things are starting to come back to reality. This is what could be happening this holiday season. So it's going to be interesting to see if that ends up being the case or not. I'm not really sure. I'm not going to make a call or prediction on that, because one thing that people always have to remember is there's always different ways to get people to spend more. There's credit cards, there's buy now, pay later things, all different sorts of things that these credit companies do to get people to continue spending money so that you stay in debt and they keep receiving interest payments from you. So don't underestimate the power of that. And it's also projected this holiday hiring season could end up being the slowest that we've seen since 2008 due to the high cost of labor and employment now, because people have to get paid more, otherwise they're not going to come through the door and apply for the job. That makes it so these companies hire less people. So to me, it just seems like the perfect storm is brewing around all of this, guys. You have a situation building up where the bubble is about to pop. You have a situation building up where unemployment is going up and consumer spending is going to be coming to a standstill as people continue to run out of money. And I think this holiday season could end up being a good gauge of where we're at with the economy as well. But maybe not, because Americans are kind of irrational when it comes to the holidays, I think. I think most people, even if they're broke, they're still going to go out and find a way to make sure their kids have the latest Christmas present that they want. And I'm not going to sit here and tell people what they should do or what they shouldn't do with their money. And in some ways, I don't even blame them, because they're parents that want to make their kids happy. But how far down the hole are they willing to go to make that happen? I don't know. I guess we'll find out in a few more months. So if you guys enjoyed this video, make sure you subscribe to the channel. If you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.